In this video, I'm going to show how we can use the Zig Zag indicator to create a profitable trading strategy. This is Mark from tradinginformed.com and welcome to this video on creating a profitable trading strategy using the Zig Zag indicator. This video is a third in a series that I am doing on the Zig Zag indicator, going all the way from concept, looking at different markets, and this video looking at creating a usable trading strategy. What we found before on the previous videos is that the Zig Zag indicator works naturally with a wide variety of markets. And what I mean by naturally is that without any clever entries, exits, targets or stops, it still tracks the market well as a trend following indicator. But what I want to look at in this video is how we can take the basic framework of the indicator, add in an entry filter and an entry trigger, and end up with a trading strategy that has more trades and is more adaptive to the smaller market moves. Now, what I have on the screen at the moment is the results page from the previous video. This is a trade-informed backtest model, and it is a way of testing all sorts of different trading strategies, profit target, stop loss, entry conditions, different markets and time frames. And you can use this to backtest your trading strategies, to enable you to hit your trading goals, to make your trading easier, and so you can relax and enjoy your trading. In the model that we have on the screen at the moment, we can see how the SPY ETF has performed over time using the basic Zig Zag indicator. And just to remind you, you can see on the screen at the moment how the Zig Zag is a simple trend following indicator. The Zig Zag goes long after we have a rise of 10% from a prior low, and it goes short when we have a decline of 10% from a prior high. So this is a nice simple trend following indicator. And if we have a look again at the results, we can see that over time, and this is quite a long time period, over 18 years, we have 16 trades. Now, for long-term trend followers, this is probably pretty reasonable, but most traders want a bit more action. They want to be in and out of the market on a more regular basis. Also, as backtesters, it is nice to have more trades so we can look to try and identify more statistically significant trading strategies. I have made some changes and created some new elements for the trading strategy. The first one of these is, instead of using the Zig Zag indicator as an entry and exit, I'm going to be using it as a long-term filter. Because this is a long-only trading strategy, I'm only going to be entering trades when the Zig Zag indicator is in the long direction. Secondly, I have introduced two new entry triggers. So the new entry trigger is consecutive days against the direction of the main trend. So the reversal entry requires 3 consecutive short days, 3 consecutive days when the market has fallen, and the trend entry requires just 2. So the reversal requires a deeper pullback. And I'm also using a similar method for the exit. So the reversal requires 3 consecutive up days, and the trend following strategy requires 4 consecutive up days. Now we can look at both of these strategies together. It may well be that we want to use either one or the other, either the reversal or the trend, or even a combination of both. So the first thing I'm going to do is look at the reversal strategy. So I've put here 0%, which in this case means that the 100%, all of the trades are going to be reversal trades. If you can see over here, a few things worth noting for the reversal trades. We've got a high percentage of winning trades over time and a relatively similar ratio of average winning trade to average losing trade. In fact, slightly higher average losing trade. Now, if I'm going to change this box to 100%, this means that all the trades are going to be entering on a trend following basis. And what we can see here is the average losing trade is actually slightly larger relative to the average winning trade when compared with the reversal entry strategy. Now, one thing I'd like to draw your attention to is this metric here, the MAR ratio, which is the compound annual growth rate divided by the largest drawdown, the maximum drawdown. And we can see here that in this strategy, we've got a MAR ratio of 0.4. Now, we want the MAR ratio to be as high as possible. And we can see that in this strategy, even though the compound annual growth rate is similar to the underlying market over time, the MAR ratio, which takes into account drawdown, is actually showing that the strategy is 4 times better. We can see that we've got a 55% drawdown here, which had occurred during the financial crisis, and a much lower maximum drawdown here. We can use this box here to blend the different strategies. So I'm showing here 100%, which means that all the trades use the trend entry. But if I put this to 50%, would mean that we have a blend of the reversal trades and the trend following trades. And the idea here is to take trend following days. If we have a look at the market, the idea is to take trend following trades when the market has only retraced a small amount. So we all know these times when the market is strong, we expect the market to continue to be strong. However, once we've already had a fairly significant decline from a recent high, then we want to be switching to reversal entries. So we're going to have a higher criteria. So the reason I want to use both the trend entry and the reversal entry is to take advantage of both market types. So we can very easily trade only reversals or only trend following entries, but in reality the market has times when either one or the other are suitable. So if we can have a strategy that combines both types of entries and is adaptive to the market conditions, we could have a better strategy that is more even over time. So there's one other entry variable that I've added into this strategy, and this is to add a consecutive minimum percentage. So we're entering when the market is moving in consecutive days, but this is setting a minimum value. So we want the market to have moved by at least, say, 0.1%. So this could eliminate very small changes. Or 0.25%. So we want the market to have moved by at least 0.25%. And we see what we do here is we create a different dynamic to the trading strategy. Just by making this change here, we're changing the percentage of winning trades. We're increasing the average winning trade compared to the average losing trade. We have lost something of the MAR ratio, but we've retained a high profit factor. So we can see that changing the consecutive trend minimum percentage makes quite a big difference to the trading strategy. And if we now have another look at the individual entries, we can see where the change comes in. We'd see that the reversal entry tends to perform better, certainly at certain times of the market, but over recent times has not provided many entries. And if I switch this on to all of the trend following entries, we can see that the strategy does not perform as well over time, and that's mostly because of a higher drawdown, but also the annual growth rate is not as high, but it has performed slightly better in recent times. I hope you've enjoyed this video. I have looked at how we can take a basic indicator, a basic robust indicator like the Zig Zag, and we can turn it into a trading strategy by adding some filters and adding an entry criteria that suit the way you want to trade the markets. Now in the next video I'm going to be looking in further depth at this trading strategy, and in future videos I will be looking at how we can apply this to different markets. I'm going to be looking at some different ETFs and see how the strategy performs then. I hope you've enjoyed this video. If so, please hit the like button. Please remember to subscribe to this channel for lots more content like this on backtesting trading strategies and analysing the financial markets. And for more information, please go to www.tradeinformed.com.